Welcome to News Beacon, your trusted source for breaking headlines, global insights, and sharp analysis from around the world. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss an update. Imagine the global economy as a vast, high-stakes chessboard where every move can send ripples across continents. Each nation, like a chess master, strategizes not just for profit but for power, influence, and survival. The stakes are enormous, and the consequences of a single misstep can be felt in every corner of the world. Today, on August 6, 2025, the world is witnessing a pivotal move that could redefine the rules of this intricate game. As the sun rises over major financial capitals, a sense of anticipation and uncertainty fills the air. The global financial community is on edge, watching closely as history unfolds in real time. In a rare display of coordination, China and the European Union, two of the largest holders of U.S. government debt, have announced plans to jointly sell a significant portion of their U.S. Treasury holdings. This is not a routine financial transaction. It's a calculated maneuver with far-reaching implications. This move isn't just about shifting money from one account to another, it's a bold geopolitical signal, a message to Washington and the world that the balance of power is shifting. By acting together, these global giants are challenging the status quo and asserting their influence on the world stage. For decades, U.S. debt has been considered the world's safest investment, a bedrock of stability that has bound nations together in a web of mutual dependence. Countries around the globe have relied on U.S. Treasury bonds as a safe haven, a place to park their wealth in times of uncertainty. But now, that foundation is showing cracks. The coordinated sale threatens to shake the very pillars of this long-standing relationship, raising questions about trust, stability, and the future of global finance. Markets are reacting with volatility, and policymakers are scrambling to respond. In this chapter, we'll break down why China and the EU have chosen this moment to act together, what strategic interests are driving their alliance, and how their decision could set off a chain reaction across global markets. We'll explore what this means for the United States, once the undisputed king of the financial chessboard, and for the rest of the world, as nations reassess their positions and alliances in response to this seismic shift. Most importantly, we'll examine how this bold move could reshape the global balance of power, potentially ushering in a new era of economic rivalry, cooperation, or even conflict. The world is watching, and the stakes could not be higher. The pieces are in motion, alliances are shifting, and the outcome of this global chess match is anything but certain. As the dust settles, one thing is clear: the next moves will define the future of the world economy. U.S. debt is essentially a collection of IOUs, treasury bonds, notes, and bills, sold to cover government deficits. Investors, from central banks to individuals, buy these securities for their safety, backed by the U.S. government's reputation. The U.S. owes tens of trillions, with a significant chunk held by foreign governments like China and EU nations. This system has fueled American spending and global stability for decades. Treasury securities are prized for their liquidity and reliability, making them the backbone of global finance. But this reliance on foreign buyers is a vulnerability. If major holders sell en masse, the system's delicate balance could collapse. That's the risk we now face. Why have China and Europe invested so heavily in U.S. debt? Safety and stability. U.S. Treasuries are the world's default safe asset, protecting vast reserves from global turmoil. For China, recycling trade surpluses into U.S. bonds supports its exports and stabilizes its currency. Europe, lacking a unified bond market, turns to U.S. debt for security and liquidity. Holding U.S. debt also offered geopolitical leverage. America needed their money, they needed America's market. But now, that balance is shifting. Selling off U.S. debt is a new form of leverage, signaling a challenge to U.S. dominance. It's a calculated move to assert economic independence. The old logic is being rewritten. The shockwave? China and the EU are now coordinating their U.S. debt sales. This isn't a panic, it's a measured, strategic move to apply pressure without crashing markets. For the first time, traditional U.S. allies and rivals are united in challenging America's financial supremacy. Their goal: reduce reliance on the dollar and reshape the global order. By selling gradually, they control the narrative and retain flexibility. This alliance amplifies their impact, turning routine portfolio management into a geopolitical statement. The message is clear: The world is no longer content to bankroll US deficits unconditionally. A new era of global finance is dawning. What's really driving this dramatic move away from US assets? To understand the motivations, we need to look beyond the headlines and dig into the complex web of economic strategy, political calculation, and long-term vision shaping the decisions of global powers. For China, the primary goal is de-dollarization, reducing its exposure to the US dollar and, by extension, to the influence of a major rival. By holding fewer US assets, China aims to shield itself from the risk of sanctions, asset freezes, or sudden policy shifts that could threaten its financial stability. This is a lesson learned from recent global events, where countries have seen their reserves frozen or restricted due to geopolitical tensions. For Europe, the motivation is slightly different but equally strategic. European leaders are seeking to regain monetary sovereignty, reducing their dependence on the dollar and challenging what's often called the exorbitant privilege the US enjoys as the world's reserve currency issuer. By diversifying their reserves, Europe hopes to strengthen the euro's global standing and insulate itself from US policy decisions that can ripple across the Atlantic. Both China and Europe share a growing wariness of US political gridlock and the ballooning American debt. The risk that US domestic politics could trigger a financial crisis is no longer theoretical. It's a real concern for foreign governments managing vast reserves. By selling US bonds, these nations can reinvest in gold, diversify into other major currencies like the euro or yen, and seek out alternative stores of value that are less vulnerable to US policy swings. They're also channeling funds into strategic projects. China, for example, is ramping up investment in its Belt and Road Initiative, building infrastructure and forging new trade routes that expand its influence across Asia, Africa, and beyond. This is prudent risk management on a global scale. By spreading their investments, these countries are hedging against uncertainty and preparing for a world where economic power is more evenly distributed. But make no mistake, this is also a powerful political message. By reducing their reliance on the dollar, China and Europe are signaling that they will not be held hostage to US decisions. The message is clear. The US can no longer act unilaterally on the world stage without facing consequences from other major players. China and Europe are actively pushing for a multipolar world order, where power is shared and no single nation dominates the global financial system. Their vision is a world where economic influence is balanced, and international rules are shaped by consensus, not dictated by one country. Ultimately, this shift is about more than just financial returns. It's about rewriting the rules of global power, challenging old hierarchies, and building a new framework for international cooperation. The coordinated sale of US assets is a direct challenge to American dominance, a signal that the era of unquestioned US financial leadership may be coming to an end. The world order is shifting before our eyes, with new alliances forming and old certainties fading. The US must now adapt to this new reality, one where its actions are scrutinized, its power is checked, and its role in the global system is no longer guaranteed. The United States now stands at a critical crossroads, facing immediate and far-reaching consequences as global investors, particularly from China and Europe, begin to offload their holdings of US government bonds. This sudden shift in international sentiment sends shockwaves through the financial markets, causing borrowing costs for the US government to rise sharply. As these major economies reduce their exposure to American debt, the ripple effects are felt not just on Wall Street but across the entire nation. Higher interest rates mean the government must allocate a much larger portion of its budget to servicing debt. This leaves less money available for essential programs. Defense, infrastructure, education, and social safety nets all face potential cutbacks. Federal agencies scramble to adjust, and lawmakers are forced into heated debates over how to balance the books without undermining critical services or national security. The era of cheap borrowing, which fueled decades of economic growth and government spending, could come to an abrupt end. Policymakers are confronted with tough, often unpopular choices. Should they raise taxes on citizens and businesses, cut spending on vital programs, or risk plunging the country into a dangerous debt spiral? Each option carries significant political and economic risks, and none offer an easy way out. As foreign investors convert their bond proceeds into other currencies, the value of the US dollar could drop. This depreciation would make imported goods more expensive, fueling inflation at home. Everyday Americans would feel the pinch at the grocery store, the gas pump, and in their monthly bills, as prices rise across the board. The Federal Reserve, America's central bank, would find itself in a precarious position, caught between the urgent need to fight rising inflation and the equally pressing risk of triggering a recession by raising interest rates too quickly. Every decision becomes a high-stakes balancing act, with the potential to shape the nation's economic future for years to come. Policy missteps or miscalculations could easily trigger further instability, shaking investor confidence and eroding trust in the U.S. economy. The stock market could see wild swings, and businesses might delay investments or hiring, deepening the sense of uncertainty. In this environment, the United States must navigate a financial storm with exceptional skill and coordination. The margin for error is razor-thin, and the consequences of failure could be severe, potentially leading to deeper economic pain, higher unemployment, and a diminished global standing. The stakes have never been higher. Every decision, every policy, and every negotiation matters. The world is watching, and the pressure on American leaders is immense. There is little room for mistakes, and the clock is ticking. At this pivotal moment, America's financial dominance and its role as a global economic leader are truly on the line. The choices made now will determine not just the nation's prosperity, but its place in the world for generations to come. This isn't just about finance, it's a direct challenge to the dollar's role as the world's reserve currency. Since World War II, the dollar has been the backbone of global trade and power. Now, China and Europe are accelerating the shift toward a multi-currency world. The euro and yuan could gain ground, reducing U.S. influence over global markets and sanctions. The transition will be volatile, introducing new risks and complexities for businesses and investors. The U.S. will have to adapt to a world where it's one of several economic poles, not the undisputed center. The era of American financial hegemony is fading. A new, more competitive global landscape is emerging. Ordinary people will feel the impact. Rising interest rates mean higher costs for mortgages, car loans, and credit cards. Inflation from a weaker dollar will make everyday goods more expensive, squeezing household budgets. Businesses may cut jobs or scale back investments, slowing economic growth. Globally, developing nations with dollar-denominated debt could face crises as exchange rates shift. Trade disruptions and financial instability could ripple worldwide. The transition to a new order will be rocky, with real hardship for millions. The grand chess match of nations has real consequences for everyday lives. The stakes are personal, not just political. The China-EU debt sale marks a turning point in economic history. The risks, rising U.S. rates, a weaker dollar, global instability, are real and immediate. The world is watching how the U.S. responds. Will it manage the fallout or stumble into crisis? America must rethink its economic strategy, focus on fiscal discipline, and rebuild alliances. The old rulebook no longer applies. The global economic landscape is being rewritten before our eyes. Navigating this new era will require foresight, adaptability, and a willingness to change.